Hi, I'm Neil Carstairs from Mortgage Corp, your property investment mortgage specialist. We are getting so many inquiries recently from self-employed clients. This is something we specialise in. Self-employed clients are people that either own a company or are working under an ABN, working as a plumber, working as a professional in any space, but you lodge your own tax returns for your company or business rather than getting payslips from an employer. What we're seeing at the moment is a lot of inquiries from self-employed on how do I go ahead and get a loan if I'm self-employed, because it is tougher to get a loan. We try not to say the word tougher, it's just that there's a few policies that we need to tick off along the way. And the two options we're going to give you today are how to look at being self-employed at either A, refinancing, or B, purchasing, being either self-employed with tax returns or not being able to get tax returns. What options do you have and where does that put you as a borrower? Being self-employed, the number one thing we need to look at is ABN. You need to have had an ABN for at least 2 years. Generally, we look at GST registration for the same period. We also look at 2 years tax returns for yourself or your company and profit and loss statements. This is where it gets a little bit different from lender to lender. Some lenders will assess you on 2 years worth of business income. So whether it's your income, business income, we put it together and we take an average of the 2 years. Okay. Other lenders will go off the most recent financial year, as long as we supply your last financial year and have a reason for any differences that might be. Being self-employed, there are a lot of benefits. So driving a company car that you possibly use for 80% business. There's a lot of stuff that you might have as equipment where we can look at things and adding back what we call depreciation. And then there's interest. This is where it gets even trickier. So I'm just going to give you a bit of an overview on how we assess a client's self-employed position when they're able to supply as much documents as possible. So we have a client who's 2 years ABN, has been registered for 2 years, is trading in either self-employed or as a company, but has been able to give us 2 years tax returns. When we assess our client, we look at the two options. How was his previous year? Was it a good previous year considered to the most recent year? Was there any differences? Was this year less or more? And what are the reasons when we interview our client for those differences? We might have gone on a holiday. They might have had some capital expenses in one particular year that are once off that we can look at as well. These are the things that we need to determine when you're self-employed on which lenders would look at your income based on how we present it, based on their policies. So as a broker, we have so many different lenders that love self-employed clients. Those clients, we can actually use their most recent 1 year's tax return, even though you've got 2 years ABN. Other lenders will take an average of 2 years. Other lenders will look at the lower of the 2 years, if the lower was more recent versus the one previous. We can look at add-backs and depreciation. So generally you can depreciate an item in your business, an asset, under 20,000 in one financial year. So we can look at adding that back to your income, because your accountant's role is to minimize or look at best ways of saving you money in your business, including different tax options that are available to you. Our job as a broker is to maximize your borrowing capacity based on your needs and requirements and the information that your accountant provides us. Okay, so in this scenario, this is what we call a full doc client. Full doc, 2 years, ABN, 2 years company, profit and loss. We're able to add back depreciation, interest. We can also look at ways of adding back extra super, so excess super, where a lot of accountants and financial planners are telling our clients, you're making a profit, let's put some extra money into super. If it's above the minimum requirement of 9.5%, we can actually add that back because it's not a legal requirement that you have to pay that. You've chosen to pay that which actually lowers your taxable income from your company. So these are some of the ways that we can look at increasing your borrowing capacity or looking at the way that it's assessed. So if your company makes a profit, and let's say company tax returns are like, company tax rate's like 30 cents in the dollar. So a lot of accountants might turn around and say, hey, leave some, your company got some profits, you've got some wages, we can add your company profit to your wages and use that for servicing with some of our lenders. So there's some real win-win scenarios, and we can't determine that until we've actually sat down and crunched the numbers. Then there's the flip side. This is not one of our favourite loans, and it is a last resort for some of our clients. And we do our due diligence and have to make reasonable inquiries when looking at a low doc scenario. So a low doc scenario is generally where a second tier or third tier lender will say, based on the information you provide us in either three formats, whether it's either a BAS statement or business activity statements, usually the last 12 months, a bank statement, and that again is usually the last 6 months, and or an accountant's letter. Now, the accountant's letter is generally done in the lender already has a format of what questions they need the accountant to answer. How long they've been your accountant, what's your taxable income, and that obviously you haven't been able to lodge your tax return for whatever reason. Our job's not to determine that. Our job is to determine that we've made reasonable inquiries, that you've been able to provide us this information to look at a low doc option. Now, the difference between a full doc and a low doc option is generally comes down to LVR or percentage of lending. It comes down to interest rate. It also comes down to fees. And this will determine whether we look at what options are available to you. So the reason we ask for your BAS is we need to know that you're trading, so that you're actually turning over money and that you're actually paying your tax or have GST implications. We need to see your bank returns. This could be an option where we need to see that you've been banking money on an ongoing basis. And then your accountant's letter to confirm your reasonable idea of an income would be X amount of dollars. We would then use that information to make an assessment on your borrowing capacity. So the difference between these two products is pretty clear in the amount of information you provide versus low doc, where you don't provide a lot of information, but the disadvantages of doing that is that your interest rate is much higher. Here, you're what we call a full doc. You have access to all products from a bank. And you generally have access to a lot more lenders. Whereas if you go low doc, there's only a few different lenders that specialise in low doc lending. Whereas full doc, a majority of the lenders have a policy or product that will suit most clients across the board. So you can actually go get the same product as someone, Joe Bloggs, who gets paid every week and gets a salary and a pay slip, as long as you can verify that. When you borrow under here, you can potentially borrow up to 90, 95%, not a problem. When you go here, we're talking 60, 70, 80% loans. We're talking much higher interest rates, sometimes up to 2% more by being a low doc versus being a full doc. Secondly, fees. A lot of these second tier, third tier lenders have higher fees, application fees, risk fees, valuation and legal, which could apply over here also. But when you take into consideration the low LVR, more deposit, more equity required, higher interest rate, so ongoing higher costs, and setup costs, which are also going to be higher, 1%, 1.25%, which also add to the cost of purchasing or looking at a property. These are really suited to clients who've been able to save a lot of money. They just haven't done their tax returns in the most recent year. And it's not that you are legally obligated to either. Some of our clients, when it kicks over January the 1st, they don't have to do their tax returns until February, March, April, May, and they haven't done their tax returns, but they've got good turnover, good business and good savings. We could look at a low doc option if they needed to get into a house or refinance there and then. Whereas some of our clients who do their tax returns as quickly as possible, they make it nice and clear. We have opportunities to add back depreciation, interest on expenses, excess super, as well as company profits and their own income. We can look at better options in getting our clients more competitive products with a lot of different lenders, with lower fees, lower interest rate, and a higher LVR. So this is just a very quick wrap up on being self-employed and what things to consider. I really do hope you get as much information as you can from this. I've written a lot of articles on our website, mortgagecorp.com.au, and I look forward to speaking to you soon. I'm Neil Carstairs from Mortgage Corp, your property investment mortgage specialist.